Hey everyone, so in this video, I'm going to be covering how we treat these nodes in terms of the margin of error or the buffer that we assign to them. So first, even apart from the heat maps, in general, when you're trading, right, we have a support resistance level, let's say around here on NVIDIA, right, where we rejected strong here, we bounced here around the 13th. This is just simplification, but most times these are actually more appropriately drawn as zones or boxes than actual levels. So a lot of times, it's more accurate to actually draw them something like this, right? Where we have sort of $2 to $3 zone, and as you can see, price tapped in, rejected. We got some other rejections around here. We held under the zone here, and also we got quite a few bounces upwards, right? So a lot of times this is a more appropriate way. It's just that obviously this takes a bit more time, so we usually just default to drawing the horizontal lines. So any kind of like supply and demand background or video will cover, and it'll be very zone based, right? So actually the heat maps are very similar where it's, obviously the nodes that we're seeing are for a specific number, but typically that's not actually just that finite number and that's it. It's essentially a zone that's allocated to it, right? So it's very important that sometimes we look at these nodes and we can tell ourselves, okay, it's possible that we reject exactly at the level, but it's also possible that we reject a little bit under or a little bit past, right? So obviously, we can use whether a node is positive or negative to help guide us and say, okay, can we expect an overshoot or not? But it's also very important to check the chart and see, okay, if we have a ballpark that we're going to reject somewhere around 180, just in this example of NVIDIA, can we look at the chart and identify any kind of double top support resistance flip that can help pinpoint what is that exact reversal spot, right? Because if we have a strong node at 180, but then we come over, look at the chart, and there's a very clear support resistance that's a bit higher than 180, maybe we want to wait until 181 is tapped before playing a reversal, right? So it's always beneficial for us to check the chart and to recognize that any of these nodes have a bit of room for error. There's a bit of buffer where we can reject early, we can overshoot and reject late, and don't always take it so literal as, okay, we're playing the number and that's it. We must reject there. That's probably that's too much of an oversimplification, right? So there's a few things that go into this, right? Of course, on the I'll cover the indexes at the end, but in terms of individual tickers, you need to know the ticker that you're trading, right? So there's going to be tickers that overshoot their nodes, um, or sometimes where you have to give them a wider sort of berth than other tickers, right? So anything that's very, very volatile. So for example, CoreWeave one is one that I've traded quite a bit where or at least I know is as we approach those nodes, we're either going to bounce pretty early or we're going to get a pretty steep overshoot and then bounce pretty late, right? So even if it's respecting the level overall, we may get some pretty violent wicks past, or we may bounce quite a bit early. So it's important to know this can happen when we're, sort of planning our day or planning our trades, and when we're setting alerts, right? So whenever I may be charting out plays and checking heat maps, if I see a strong level at um, whatever number, if I know that ticker is very volatile, sometimes I'll place my alert a little bit above the actual level itself because I know that price could reject early, right? So I want to, at least keep my eyes on it, look at the chart, and try to see, okay, where does it look like we may reverse? Um, so the node will give you sometimes like a ballpark, and sometimes you're able to enter like just off the node itself, but a lot of times it helps to take a look at the chart and say, okay, in the vicinity of this node, where do we see some levels that make sense, right? So the general rule of thumb I use is I'll just give each node basically one node up or down. So for example, here in NVIDIA, right? I'm looking at this and I'm saying, okay, like it could either reject early around 170, 178, or we could wait until 181, 182. And a lot of times this is usually enough margin for error or buffer that you're accounting for the full range. So for example, NVIDIA's most recent rejection, I don't know what the map looked like a few days ago actually, but this rejection happened at just over 181, right? So this is a good example of, okay, we may have gone and tapped this node, but we overshot it a bit. And instead of immediately flipping to saying, oh, like we broke above 180, this must now be a floor instead of a ceiling, What I'm thinking is, okay, this is potentially an overshoot because we haven't broken like fully above or far enough past that I'm considering it to be a break of the level, and now that it may flip to a support, right? So usually when I want to look at a level and say that it's truly broken and has flipped, I'm usually looking for it to go past that one node, right? Or even two nodes past the level. And then I'm saying, okay, I think now this is a case where it's definitely broken past the level. But again, you need to know what ticker you're trading, right? There are some tickers that move a lot more stable than others. So again, like something like CoreWeave, Rigetti, I don't know, even like GameStop, let's say, those will be pretty violent movements when they get going and when they get these bounces. Whereas if you're trading something like Ford or even Coca-Cola, right, it's going to be a bit more slow moving. So knowing what ticker you're trading and the behavior of it is going to help you a lot to identify, okay, is this just an overshoot or is this truly a break of a level? So that combined with some of these tips I gave of like how much buffer you give to either side. Okay, now in terms of the indexes, the general rule of thumb we use is actually an SPX node. Now, obviously, SPX has it's basically just a higher scale of SPY. So what happens with the SPX map is you actually get more strikes, right? So for SPY, if you increase $1, it's the same as a $10 move up in SPX. But SPY obviously only has strikes at those whole numbers, whereas SPX has strikes at when they end in zero and when they end in five, right? So basically, SPX has strikes that account for a $0.50 of SPY, if that makes sense. So the you can't just use one node for the indexes when you're looking at Trinity, because one node passed on SPY is going to be two nodes passed on SPX. So you need to be consistent. So if you, the general rule most people use is just one node on SPX, so $5 on SPX, which correlates to 50 cents on SPY and QQQ. And if you're in a very volatile environment, so obviously like recently with all of the news going on in the Middle East, we've had a very volatile environment. So sometimes I'll actually up the buffer and I'll say, okay, I'm going to give a little bit more than $5. Maybe I'll give all the way up to $10, but usually like $7 or $8 up, max 10, which correlates to $1 on SPY and QQQ. So due to the volatile environment, I'll increase my buffer a little bit. But typically under more stable conditions, we're looking at a $5 for being like the max overshoot or bounce or early bounce. So $5 on SPX and 50 cents on SPY and QQQ. So this is going to be pretty important where sometimes you're going to have floors and ceilings that don't align perfectly on the indexes. But if you recognize that one is overshooting, but is still, within that $5 of an SPX node, that it may look like it's overshooting, but it's actually still within that range where it can sort of snap back and bounce back and hold the level. So a lot of times that helps us where we have, okay, one that appears to be overshooting, but we look at the other, we may have a floor on another index, on the SPY map, for example. And so if we know that the SPX node is overshooting, but a low amount, so still within that buffer and within that zone that we've assigned it, then that can be that can help us stay in a play, for example, right? So this can be very helpful. Like what I used to do in the past is I would come in and, for example, any strong levels, so let's say like 64.50, right, on SPX. What I'd do is I wouldn't actually mark out the line. I'd draw the whole zone, right? So I'd draw from 64.55 down to 64.45. So I'd be saying, okay, here's our potential SPX support zone. Then, this is something where if you have them overlaid or even if you have them side by side, you can also draw out the other zone. So if I'm go pull up the SPY, where I say, okay, SPY has a support zone down here. This is where you have 640, and then I give it sort of 50 cents to either side. And this is how I'm drawing out my zones. Um, One thing I'll mention here is this can be very helpful when you have overlapping, right? So when we have floors that align very closely, so let's say SPX had a 6450 node, and let's just make up the scenario where SPY had a 642 node, right? So when these zones start to overlap, based on the heat maps, these are going to be those plays that work very, very well. But since you have a bit of buffer both ways, you actually end up with a wider zone, right? So like the 6450 box is the higher one, and then here I'll color it separately just to make this more clear. but then our imaginary 642 box is, or zone is a bit lower, right? So a lot of times what I'll do here is I know that price can bounce off the SPX buffer early, or worst case, it could go all the way down to the low side of the SPY buffer and bounce there. But many times when I have these overlapping floors or ceilings, I'm trying to enter on the in the middle, right? So I'm trying to enter in the overlap between those two zones or the two buffer zones of the indexes. And that can make it a pretty straightforward, not straightforward, but it can sort of simplify where you say, okay, because one of the big questions always is, do I enter early? Do I enter late? When do I enter? Um, so when you have matching floors and ceilings, so obviously this only happens on the indexes. This is a quick little trick that I would use quite often is I would draw the two zones out, and then I would be trying to take entries on the in an area that aligns on both, right? Now, one other thing I'll cover in this video is, and let me just sketch this out somewhere random, is if we do have a zone, right? So if we have a node, so let's say on NVIDIA we have a node at 205, right? So you come in and you draw your zone from 205 and you give it, let's say like $2 in either direction, right? So we're looking at some of those 207 down to 203, just to make up numbers. As price is approaching, so let's say price is coming from above, this is ceiling, and we're trying to play this rejection. The whole buffer is put there, there's a chance that we bounce at many different points on the buffer, right? And we don't always know as price is going. So obviously if we have strong double top at the top zone, then we wait a little bit deeper. If we have a strong double bottom here or double top here, we wait maybe we enter a little earlier. But let's say we have like a bit of a lack of like really clear chart structure. So we just know we have the zone from the heat map and we're trying to decide how we take this play, right? There's always three options. One, you take it early. Two, you take it like at the midpoint. And then three, you wait for the safest entry when we fully tap the end and you take it there, right? So the key point here is like you have three different kinds of entries with different levels of aggression. So this is something that each of you will have to decide for yourself how you choose to trade some of these nodes, right? So if you're a much more aggressive profile, right, you're probably going to take this entry one. Oh, that's a bad one. One. Whereas if you're more of a medium risk profile, you probably do entry two. And then if you're very safe, you'll do entry three, right? So then what are the pros and cons of each of these of entering at each level is obviously if you take entry one every time, you're going to miss many less trades, right? Because as soon as we tap a level, even on the early side, you're getting in, right? If now the drawback is if we tap this node, right, and we end up going all the way and overshooting to the far side, if you took entry one, you're going to be sitting through this big chunk of drawdown, right? You're going to be sitting through all this drawdown here, which obviously it depends a bit on time, but this could be very low if it's a very quick move. This could be 5-10% if it's a strong, like very quick wick. But if it's a very slow move, it sort of overshoots and it takes a while to get going back, or maybe it chops and then reverses later. Like you can be sitting through some pretty heavy drawdown for entering early, right? Where you're looking at 30 to 50% drawdown. So again, that's the trade-off there is you're going to take more trades, so you're not going to miss any moves. But some of the moves that do overshoot, you're going to be sitting through a lot more drawdown, right? Now, to go to the other extreme, so point three, obviously point three, you're probably going to have way, way less drawdown than any of the other two spots. But the main issue here is if we don't overshoot severely, you're just never going to get into any trades, right? So you have this issue where your entry is going to be very good, but you're not taking as many trades, right? So again, this is a personality thing. Some people are happy to wait and take one trade a week and get a very good entry. Some people want to be trading a couple times a day, so they want to get a bit of a more aggressive entry, and they'll deal with a bit extra drawdown if needed, right? And then finally, point two is just a middle ground, right? So it doesn't have to be the midpoint. It can sort of just be anywhere within this box. But at that point, you're looking more at sort of a middle ground approach, like let's say like a Goldilocks approach, right? Of okay, you should be able to capture quite a few moves, like you're going to miss a few, but at the same time, you're going to have much better drawdown on the majority of those moves. But you're not going to have like that pure sniper entry because if we do overshoot fully, you're still going to be dealing with a little bit of drawdown, right? So again, this is something you need to consider just anytime you're taking a trade. Um, I would not let this logic override what you're looking at on the chart. If you see a very clear level on the chart, use that to guide yourself and just recognize that these nodes are sort of a buffer. So if you see a very clear level on the chart, I would take that as priority, whether, even if it's on the low side or sorry, the early side or the late side of an entry. I would still prioritize whatever level you see on the chart. Now, the last thing I'll say is everything I spoke on this aspect of getting your entry in based on the early, midpoint, or the late entry is assuming you're taking a single batch entry, right? So you're buying all your contracts at the same time, same price, etc. Obviously, if you scale into trades, this is probably something you want to do no matter what. So it'd be okay if you're trying to scale in with volume, is you say, okay, at point one, I'm probably going to scale in just to make up a number, like a quarter of my position. Once we hit point two, I'm going to throw in another quarter position. And once we hit point three, or not once, but if we hit point two and if we hit point three, then I'm going to throw in whatever's remaining of my full size, right? So if you are going to scale into these trades, the only caution I have is make sure you define your risk beforehand. So if you're trading a $10,000 portfolio, you know that you want to risk 5% per trade. So that gives you $500. If you're scaling into this trade, point one, you probably want to only put in 100. Point two, maybe you put in 150, 200. And then at point three, you'd be putting in everything that's left, right? So make sure your total size after fully scaling in at point three, that'll give you your full size, right? So you need to define your full risk beforehand and make sure the way that you scale in is going to result in your full risk being accomplished by point three. Because if you're fully sized in by point one or two and you size in more at point three, what's happening is you're not going to be going over your risk parameters, right? So make sure to define your risk and pre-plan if you're going to do a scale in approach, but that's how you can use sort of these buffers to plan your scaling in of your trade, right? Okay, so for this video, that'll be all. But this should help when reading some of these nodes because a lot of times we tend to oversimplify. We see one number and assume that we must hit that number. And then so we get a bit thrown off if it rejects early or later. So hopefully this helps clarify how we can look at some of these buffers and give a little bit of margin of error for these nodes, um, and better execute when we have a strong thesis, and so we're able to trade it more effectively.